Hi, welcome back to Wild Wealth Optimization Workshop. Back here with Scott Clark, the Call Dog. Delighted to have you back talking about a real exciting topic today. MERs, management expense ratios, or the management fees associated with managing your investment accounts, such as mutual funds especially, also segregated fund type accounts. But ultimately, there'd obviously be brokerage fees and different things if you were buying individual securities like stocks or bonds, but this is more in relation to typically to mutual fund type accounts. And despite it being kind of a dry, boring topic, it is one of the most common things we hear people talking about. There's a lot of advertising, a lot of misinformation out there about management fees. So we want people to understand that, and you might have a 2% management fee or whatever it is for your specific mutual funds that you hold or that you're looking at buying. Every company must have full disclosure and declare what their fees are and what those costs are going towards in your fund facts that you would receive and when you're meeting with an advisor. But we want you to understand some of the pieces. Of course, the government always wants their tax piece, so that's just going to be part of it. There's day-to-day operating expenses of that mutual fund company and the investment management fees associated with it, to have world-class investment experts managing multi-billion-dollar portfolios with, you know, dozens of financial analysts and software tools, and going and meeting with CEOs of companies and doing all kinds of in-depth analysis. It takes a significant amount of work. Those fund companies obviously have their overall operating expenses and administration and marketing and all kinds of things, you know, sponsoring golf tournaments and all kinds of things that you see those fund companies doing related to cost. There's also something called trailing commissions, often a misunderstood piece too. Every advisor has to work under an investment dealer, and that investment dealer, whole variety of different investment dealers out there, but they are the ones not only responsible for administering which funds are on their product shelf that they have available, but all the paperwork and computer related work and things associated with processing trades and purchases and monthly contributions, monthly withdrawals, things of that nature. Compliance is a big part of the dealer's responsibility, is to oversee the compliance of advisors and transactions that are made on behalf of clients, to make sure things are done ethically and responsibly and according to what industry regulators expect. And then of course also your advisor compensation, right? What that advisor, who typically has business expenses themselves, and their expertise, their ongoing service, their ongoing advice, and their compensation. So all of those different factors are built into your MERs. So one of the things that we're seeing in recent years is a race to the bottom around fees. Some of it is good in the best interest of clients, some I'm not so sure about. So I want to talk to you about that. Now, there, as we talked about, there's already 10,000 different mutual funds out there in the industry. Some naturally have lower management fees than others because of the nature of the fund. So a bond fund does not take the same level of expertise and micromanagement as an emerging markets fund. So by its nature and complexity, the emerging market fund will have a higher management fee than the bond fund. That does not mean that you should buy one or the other. Okay, you should buy suitable investments, a suitable diversified portfolio based on your investment objective, your time horizon until you expect to spend the money, and your personal risk tolerance around investing, not just based on what fee was cheapest. Now, when there is fees that are one thing I should point out, every company nowadays has things called, they go by different names like private client, preferred pricing, but these private investment platforms are taking your basic management fee, and then based on you hitting certain platforms. So for example, do you have $100,000 invested in a fund, or 250,000 with that fund company, 500,000, $1 million. That when you cross certain thresholds, you get reduced fees because of the size of your account versus if you had a very tiny account. Hopefully that makes sense to you, and those are mandated now by regulators, and you should expect to get those when you hit certain thresholds. The one analogy I'm gonna use, think of it like when you go to the grocery store. Okay, you have to compare apples to apples. So if you have two identical funds or extremely similar funds that are gonna have similar risks, similar volatility, similar returns, similar caliber of investment management, then by all means take the one with the lower fee that's cheaper. No different than if you went to the grocery store and if you went to a discount retailer, their Campbell's tomato soup is the same soup as if you go to a more expensive deluxe high-end store that's charging you more for the same tomato soup. By all means get it from the discounter. However, in that supermarket, if you wanted a top of the line cut of steak to barbecue in the summer, or some exotic produce, or some seafood, or whatever the case might be, there is a drastic difference in the quality of that steak at the high-end store versus the discount store that justifies their difference in price. Does that make sense? It's the same thing with your funds. So don't just buy on the basis of cheap. Garbage is always cheap. Is it cheaper of equal value? That's what you should be assessing if you're looking at management fees from a financial perspective. I hope that idea makes sense to you and that you take that to heart, that you purchase investments that are suitable to you, not just on the basis of cheap. Especially this mindset that people can handle their own investment portfolios because the fees will be cheaper. That's true, because you're not getting any service or advice or expertise, and the vast majority of people are not capable and knowledgeable enough to handle that responsibility. And saving 1% on your management fee will no longer feel good when you lose 20% in your portfolio by making bad financial decisions because of not having proper professional guidance and advice. Hope that makes sense to you. Look forward to talking to you more about investments coming up